Hi, everyone. Welcome to the TimingResearch.com crowd forecast news for March 21st, 2022. We are recording this a few days early, but it's going to be released as episode number 336 for March 21st. So my name is David Kosmeter. I'm the creator of TimingResearch.com, and today we're going to do a special Option Professor solo market update episode. So I'm going to go ahead and turn it over to the Option Professor.
Okay, great. Thank you, David, and welcome everybody here. I'm going to go over quite a bit of information, but before I do, let's give you a quick background on myself. I've been in the investment arena here for over 3 decades, and I have substantial knowledge and experience in options, where we used to do live seminars and webinars on the uses and risks of options across the whole country. So I've got quite a bit of product knowledge there, and I also follow the markets myself for many, many years, both stocks, bonds, and commodities. So, and international investing as well. So I'm going to go over a lot of that right now and give you a nice crash course on all that. But remember this, I am sharing with you my opinions and my observations. And what we're not doing here is we're not giving out any advice. Obviously, we haven't met all of you. We don't know your circumstances or your risk tolerances. So obviously, I'm just giving you my opinion on what I see and my observation. Okay. Again, at the end of the broadcast, I'll explain how you can get a hold of us if you have any questions. But what I'm going to do now is right now, we are doing this before the Fed came out with their announcement and before triple witching on Friday. So I do not have the benefit of hindsight with those reports, but I'll tell you what I'm seeing here prior to those reports and how things may shake out regardless of those reports coming out. The triple witching, which is also quarterly. And I think it's quadruple witching actually now. And then, of course, your Fed meeting. Obviously, on the Fed meeting, everyone's looking for a quarter of a point. The question is what is this statement going to look like? And basically, the statement is either going to be a reality statement where there's an admission of how high inflation is and how sticky it's going to be, and then how ridiculously low the interest rates are and how they have to be adjusted and normalized. That would be the reality talk. The non-reality talk might be that they're going to be taking a long time to normalize them, and they're going to really take their time. And if that's the way they come out, obviously that's going to be a dovish slant, and that would probably be pretty positive for the markets. So we'll have to see what the statement sounds like. If he comes out and says, we are, behind the curve on this, and we have got to normalize. We're cognizant of the geopolitical, we're cognizant of many things in China, the shutdown and all the rest of it. But again, China does not want us to raise our interest rates very fast, because the last thing they need is high oil prices and a cutback in our demand. So that would be a very, very bad situation for them. So they would prefer we don't hike our interest rates, I'm sure. Anyway, let's take a look at what's going on, and I'm going to tell you exactly what I'm seeing here. On the 20-year graph, I'm using a 12, 24, and 36 SMA, and then I'm using a relative strength. So on a long-term graph, the reason I'm long-term bullish on stocks is because you can see the blue line and the green line are under the prices and still rising. But our premise this year has been as simple as this. When we hit 4,800, we thought that might be a cyclical high in the market. And we thought that 2022 might be a reversion to the mean. Now, the first mean is 4,400, which we've already hit and penetrated. And the next mean is 3,900, followed by 3,600. So there are still 2 more legs of which we could go down. And the RSI right now is still above 50, but it's up at 58. So there's still room for the RSI to come down, hold these numbers down here, and then basically start a new uptrend from a lower level like that. That's preferably what I would like us to see. Now, if we don't see that and we start breaking above 4,400, the 12 SMA here, then I will start changing my tune. But we're at 4,200 and 4,100, so there's a lot of real estate between here and 4,400 that it could fill in, particularly if the liquidity is not there. because when the liquidity is not there, the algos and everybody else presses that side of the market. And so a short covering and a bargain hunting type situation is still possibly on the table. Now, again, I don't have hindsight of the Fed meeting or the triple witching, but I do have the hindsight of what has happened before on the third Friday of January and February this year. And when we had a options expiration in January and February, the market the week after, which would be not this week here, but the week that this is being broadcast, the market had been substantially weaker. So we'll have to see if they break that run, because January and February after the triple witching, we were followed by substantial declines. Next week, the week of the 21st through the 25th, if we do not go down, that would be changing what has happened in the prior 2 months, which might be very interesting. At any rate, we are in the oversold condition short term, and we are in a situation where there's room to bounce. And on a long-term basis, we do have these moving averages still under the price. So they are 10 and 15% under the current level, but they are rising and under the price. And I just wanted to say that makes it for a good situation. Now watch this. When you go to the 5-year graph, not so good. You've got the one SMA under the 24, and you've got it under the 36. So the red SMA is definitely pointing down, and it comes in at around 44.50. So you got 4,400 resistance, 44.50, and then you've got some 4,500, 45.50. So anywhere between 4,400 and 4,450, you got plenty of technical resistance basis these averages. The other thing you have is you got the RSI down here at 40. So again, one of two things generally happens when we're at 40, in my opinion. It either is going to have the snapback rally because 40 is a low point on the RSI, or you could have an acceleration phase to the downside if we start getting to 36, 35, 34, et cetera. So that's why I don't have the hindsight of the meeting with the Fed nor the triple witching. But if it turns out it breaks badly, then we could get a very precipitous drop after the triple witching. So we'll have to see. Again, you can see when it does break underneath 40 like it did here, this is where you get an acceleration to the downside. So right here, the RSI drops down to about, what does it drop to 40? And then boom, you go down to a low of 21. So a break of 40 here. The low recently has been about 40. So a break of 40 on the RSI would not be a good thing. It could lead to a more acceleration phase. Okay. If you go back the 20 years, and you go to the crash of 08, you'll see that when the RSI broke under 40 here, which is right around there, you had the big acceleration to the downside. So this is not a bad time to be a little bit careful, because you can see from the graphs on the 5-year that we have already rolled over a bit. And there is a lot of oxygen under here. So you have to be somewhat careful. But it is going to probably be volatile one way or the other, because in this kind of condition, a snapback rally is not off the table. If everything goes well, dovish comment from the Fed, window dressing for the end of the month, triple witching is behind us, and it doesn't cause the sell-off, then again, so that's we're going to be, I believe, in a short-term spike up or acceleration after triple witching. We'll have to see how that works out. On a 1-year basis on the S&P, you are looking at an oversold condition from the standpoint of, look, we were up here, we're way down here. It got way away from the moving averages, back to the mean. Now it got away from the moving averages and it's coming back to the mean. It ran into some resistance here on Tuesday of March 15th, right here at 42.75. So if it clears that, then you got a shot at moving up towards 33.50, 43.50, 43.75. So we'll have to see. Could that get the pop? Yeah, on a good Fed meeting and a options expiration that causes some buying activity, There you go. You got a room right there. But again, you still have prevailing trends pointing down, and that's problematic. The RSI right now is on the daily is at 44. So again, as you can see, if we take out 40 on the RSI on these things and you blow out the 4150, 4100 area, you could accelerate to the downside, not unlike this kind of thing. Okay, so you got to be careful. This is not an easy environment. As your statement, if you're long stock, you have the statements to prove it's not an easy time, right? And so there's a reason why it isn't, and that's because accommodation is being removed, inflation is very high, and now you've got geopolitical. So you got all kinds of problems out there, and you got a big shutdown happening over in China as well. All right, so that's a little bit of a view here. Again, the primary trend on this stuff is still to the downside. So it's hard to build a big case right this second for everything to go through the roof. You're going to probably have good earnings because the operating leverage is still there, and the consumers' household balance sheets have money to burn through this bad period. And the corporate balance sheets have money to burn through this bad period. So again, it doesn't look like a massive recession would happen. But when you do have high energy prices, if they stick, and if you do have high interest rates high inflation that sticks, and then the interest rates have to merge that gap, that has been a recipe for a slowdown. Not really in the cards on many people, and because of the balance sheets of the households and the corporations, people are thinking it's a low probability, and they might be right. But I certainly would give some credence if the news starts turning, because again, you do have some of the things that are the recipe for a slowdown. So anyway, we'll have to see what happens. Again, I'm going to look at some areas here today. And I'm just going to use some ETFs to give you a broad-based look. In growth, you're going to have your growth stocks in there. So let's take a look and see what they look like. We got growth having a nice snapback rally on Tuesday. But again, it is running into resistance. Okay, this is on a daily graph. And this is the spider growth. Big drop, obviously 74 down to here, big drop, but it is, everything's still pointing down, and that makes for a rough racket. Even if it has rallies, as you can see, this thing went from 60 up to 67 here, but it went right back in the soup because the trends are down. Now, if you look at the 5-year graph on it, again, very similar to S&P, oversold a bit, could bounce back, but it also could have the bottom fall out a little bit too. So that's why, we're going to know a lot more by next week. After these events are behind us. Then if you want to look at the ones that we've been suggesting as the best of the worst, which is dividends. And again, there is a value to growth chart that shows that value totally started to dominate in December of 2021. So again, that's why these charts look a lot better than growth, because value is now in preference to the growth, because the growth is feared to be slowing. Interest rates are rising. These are deferred duration type earnings. That is affected by interest rates. These people have free cash flow. They're paying back investors. That's more attractive to people, and the chart speaks for itself. So as long as we can stay above, let's call it around $41, this thing is hanging in there pretty good. Your RSI is at 56. So, this is where we've been pointing people since December, and you can see this has been the place to be. The 20-year graph still looks fine, not that much. Even the 1 year, is hanging in there pretty good. Again, 1 year would start getting a little dicey on a break under 42. And then under 41, that would be very not good. And then you really want to watch this closely, because your RSI is right at 49. So if this thing starts losing altitude again, when they sink the Titanic, everybody's getting wet, right? So if this market is going to have a move down to 3,900 or 3,600 S&P, they're going to be probably tagging everything, and this thing will get whacked with everything else, but maybe less whacked than the growth. That's the idea. And then you have value. Okay. Okay. On value, All right. Again, not as strong as the dividend. Pretty much hanging in there at the best case scenario. Still hanging in there. Not as good as the dividend, though. And if this thing starts breaking under 39, that probably wouldn't be good. The RSI is under 47. So right now, one of the only areas that look like they have any strength right now is the dividend pairs. The other one is utilities. I mean, this is not the most exciting place to be, but it's not very exciting to lose all your money either. So the bottom line is this is the kind of boring stuff people are parking money in who would like to have some stability and income on their asset. So again, this guy here, we want this to stay above 68 bucks. RSI is at 60. So this thing's firm. On a 20-year basis, what's so wrong with this? You had the big drop here. That's the crash of 2020. Other than that, this thing has been a trained seal ever since 2011. And you've been getting a nice dividend and growth of principal the entire time. Is that the worst place to be? Probably not. All right. And then, so you got your dividend payers, you got your utilities. Those are two areas that seem to be people are hiding out. And some people like their staples. That means this is stuff that people have to buy, win, lose, or draw. And let's see how that's looking. And very similar to the others. So the three musketeers, dividends, staples, and utilities certainly are in a lot better shape than the rest of the stuff. And so, but again, even that is holding on for some dear life here. This thing busts under 72. You probably are going to be in the soup with everybody else. And the RSI here, looking at about 48. So, you don't need this thing under 72. Very difficult to find a place to hide when it's raining like this, right? Okay, let's take a look at some of the stocks people like to watch. Apple. Now, they had some reports of this Foxconn that's halting production of iPhones. That didn't sound like good news to me. On a long-term graph, you got a real bull market, but is Apple really not going to break this 12 SMA the entire time? Well, if it does, you could go to 130. And if it does that, you could even go to 110. That would be shocking to people, but news can change. News can change. Like they could have trouble getting their products and that could halt their sales. There could be a problem in China. One thing I'm concerned about that's not talked about is in my knowledge of history, economic problems precede the military ones sometimes. So, China, Russia is pretty much in a depression. That sounds pretty bad. And to give you an idea on how China is doing, just take a look at one of their biggest companies and you tell me how they're doing. First of all, they have a big lockdown going. That can't be good. And look at Alibaba. It used to be $320. You know when? October 2020, which is what? Not even 2 years ago. And now it's trading at 76. So something's going on over in China and it's not very good. So, one of my concerns is that, if economic problems precede military and geopolitical problems, the two biggest players there are Russia and China. And looks like their economics is set up for problems. So I view that as concerning. And you look at history and tell me if economics didn't precede a lot of problems in the military area. Okay. Okay, hang on. Let me get back to here. All right. So anyway, I gave you the Apple idea. Then I gave you the S&P, which Apple is a big part of. Now let's take a look at the QQQ. Now, again, it broke underneath its red line where Apple hasn't, and it's tested the green right here. So obviously this is a support zone, and this would be a place to trade against if you want to be aggressive, or there could be another leg down. Okay, your RSI right now, let me put that back up again quickly. And draw it up. RSI right now is still above 50, but it's being tested down here in the 53 area. So if we got a nice gap down there, that could be the end of it. Again, a lot of people are looking for Apple to break, They're looking for the VIX to get above 40 on a big panic. They're looking for the put call ratio and the advanced decline line to start hitting a big panic. And then they'll be willing to say that the second half of the year might be a lot better, and they'll jump on that train where the worst is behind us. Right now, they're concerned that train has more rail to go on, and they have a reason for that. Okay, let's talk about, so let's look at it on a 5-year basis. And you can see, it broke. It broke, but it's oversold. And again, if the Fed meeting and triple witching gets behind us and there wants to be a short covering rally, this is the neighborhood where it could happen. But I'm a little bit concerned that you're at 35 on the RSI, because that is not a good reading. That's the kind of reading of potentially a very negative situation happening. Looking at the 1 year, RSI down here is coming back off the mat. Down here, the RSI bottomed at around 35, and now it's up 42. So the good news is, as of Tuesday, March 15th, the RSI was trying to turn up. And again, all these lines are pointing down, but they're well above the market. So a rally here from 328 into 335 and 345 would not violate the downtrend. So keep an eye on that. And again, let's see after it does run up, if it does one of these numbers where it runs up and then falls apart again. So we'll have to see. Okay, so that's your NASDAQ, that's your QQQ. Anybody want to look at the semiconductors? We'll take a look at the semis. Now, again, there's a lot of problems in electric vehicle land and in semiconductor land. And it has to do with the raw materials that they use, their availability, and their cost. So again, this is the semis, totally topped up here with about a quadruple top. And then basically you got your sell signal right here at 305. This thing has been coming down, down, down. The RSI has bottomed out at 39, and now it's trading RSI at 42, and that's on the 1 year graph. So you want to keep this from getting well under 40. Okay. And again, on a rally, look at that rally. You got a lot of room there, 255 and 265, and still being a lousy looking market. The 5 year, again, all the averages up here in the 275 to 280 area. So plenty of real estate between 240 and that number. So you could get a nice bear market rally on this thing. And again, on a long-term basis, will it hit the green line that comes in at 222, or will it have a full reversion to the mean? And that would be 192. So we'll have to see. But again, there's a lot of problems in the EV space and also in the semiconductor space. And again, there's a lot of factories being built and a lot of things being built on both areas. But if they don't have the raw materials, or the raw materials are cost prohibitive, it could have an effect on this stuff. So keep an eye on that. Now let's go over to the over-the-counter and the small caps. Small caps are called the Russell, and IWM is the vehicle that we look at. So on the small caps, again, this thing violated here and came all the way down here, and it hasn't gotten to the 180 mark, which it still could do. You don't know. But the RSI here looks like it bottomed at around, well, here it looks like it's in the 50 number. So it's been holding the 50, holding the green line. That's not so shabby. Now let's look at your 5 year. Not quite as good. This 12 SMA is pointing down. That's not good. So right now, your resistance here is going to be at about 205, followed by 214 and 217. So you got a lot of clouds above. Could you rally up on a short covering rally or something like that? Absolutely. Your RSI bottomed here at 38, 36 area. And now it's moved back up, not very much, but a little bit. Okay. So there you go on the Russell. If you're looking at it on a 1 year basis, again, getting above 200 and 205, we mentioned that number, would be very much of a potential turn at that point, because your RSI is at 45 and you'd probably get it into 50. So you start trading this thing 200, 205, that would be an initial turn in this market. But, buying against the downtrend has not been the way to go, because of the fact that the downtrend is still controlling the prices, as far as in our opinion. Okay, now let's look at your transports, because a lot of people are getting into the railroads and they're getting into FedEx because, again, they're believing that we are going to have the bottlenecks get easier, and we're going to have to deliver all this stuff. And these guys are going to be the ones who deliver it, the rails and the truckers, right? Okay, so on a 20-year basis, let's see what the transports look like. And they look like they're in an uptrend. They barely broke down, so they're pretty darn strong. And the RSI is strong. So getting back above 260 would be a really good sign. 261, that'd be a great sign. Otherwise, it looks like we might go back into the soup. And if we do that, 214 and 230 would be two levels underneath where the averages are coming in. If you look at the 5-year, again, a lot of resistance at that 260 number. That's where I'm getting it. So keep an eye on 260. You start trading above that, that would be a good sign. 260, then 265. That'd be a very good sign. And the RSI is at 46. So if we started doing that, you probably would get going. So keep an eye on that. And again, that could have a bright future because as the bottlenecks were to loosen, the stuff has to get to the stores and everywhere else. And of course, trucks and rails are the way it does it. Okay, let's look at your 1 year. And the 1 year, again, still being controlled by the downtrend. But if we could get above 260 and 265, you can see that would turn that up. So keep an eye on that area. I happen to think it could have potential once we get all of this bad stuff behind us, which hopefully could even happen by the end of this month. Okay. Another area that we see as potential for the second half of the year, if we don't go into a big recession and if we are just seeing the calm before the sunny weather, the rain before the sunny weather, it would be in the entertainment area. Now, I'm going to look at a couple of different things. This is a broad-based ETF on entertainment and travel, and this is called Leisure and Entertainment. It's ATF, and if you look at the 20-year graph on it, let's take a look. Yeah, you see it's holding in, and this is the number you'd like to have it hold, right around $40. And the RSI is right at 50. So this is an area where if you're a believer that the second half of the year is going to have people traveling. Now, I'm going on, the reason this is being pre-recorded, I'm going into a holiday in the Caribbean. And I had to get a COVID test, which obviously is nerve-wracking because until it says it's negative, you don't know if you're going to go on your trip or not, right? But I did ask the guy down at Walgreens if it seems like, you know, the COVID is waning down and this and that. He says, well, I can tell you one thing is that a lot of the people who come in for tests are traveling. Well, that's not a bad indicator that what? People are starting to do a little bit more traveling. When they travel, what do they got to do? Well, they generally go and call Expedia or Booking.com maybe. They also probably maybe use some Airbnb, and they also go to hotels and they need rent-a-cars. And of course, they got to fly there. And of course, when they get there, they might want to eat. So the bottom line is I'm trying to look at areas like that to see if there's any potential for the second half of the year, because you got to look where the puck is going, right? Okay, so on leisure and entertainment, there you go. It looks like it might be holding on, so that's not a bad sign. On a 5-year basis, again, it looks lousy. You know, it looks lousy. And again, the bears are definitely still controlling it. If we get above 50 and stuff like that, that would be a better situation. The downside here, again, the bears are still controlling this stuff. Okay. That's why, you know, I keep telling people a bounce is not a trend. A bounce is not a trend. Okay. Because again, remember that what we said, 4,800 was a cyclical top. Coming from the 2000 number, which was a 20-year cycle, and coming from the 1980 number, which is a 40-year cycle. Okay. So we are operating on the defensive. We are still positive longer term because of those long-term averages of 3,600 S&P and 3,900 S&P still not being violated and still rising. But in the shorter term, obviously, it's been totally a negative deal. So obviously, if you're holding on through a blizzard, you're going to get snow on you. But again, here we're going to be patient and we're waiting for the tides to turn, but we think there could be potential here. Now, again, going over some specifics, jets is something that gets you into the airlines. So we saw 40 is a number for the leisure. Let's look at the long-term graphs and see what this looks like. This thing has got to really get above 22 and then 24, and then it opens up all this stuff up here. So again, you still don't have a very good looking graph on this stuff. And that's why you got to be careful that you're not buying a dead cat bounce. Again, we could run up to 21, but if you don't take out 21 and 22, this neighborhood will never be visited, right? So might be, sometimes people say it's better buy at 23 than it is 19, because at 23 you have momentum and maybe it's on the way up to 29. You buy it here at 18, it's going to stop at 20 and make new lows. That's not a good thing. Okay, the next area would be something in the travel area, Expedia. And that's been going in oh, that's Exxon. Come on, guys. It's been going in fits and starts. Okay, fits and starts. So we've been in this thing as far as suggesting it's a good idea, and then we've been out of it, and you can see why, because it's kind of all over the place. Down here, obviously, when things get this far away from their moving averages, we are starting to think about reversion to the mean, which it already did. So let's look at the 20-year graph on it, and you can see it's still got all its support. You see reversion to the mean when it's up at 220 and you tell people it's going to go to 170 or 140 or 130, they look at you like they have 8 heads. But, just like down here, when it's at 40 and you tell them it's going to go back towards 110, they look at you like you have 10 heads. But you got to remember, when things get way away from the mean, they come back. And we consider the mean the moving averages. Okay, so you got to be careful buying it at 220, and you got to be careful selling it at 40, right? Now, right now, it's come back down. It's still got some potential to dip further. But you can see it's been all over the place in the month of March. It's been as low as 150 and as high as 200. So it's getting wild out there. But this is one of the stocks that would benefit from travel picking up. So anyway, just giving you the idea of travel, the idea of shipping, okay, for later in the year. And some of it might have already started now. Okay, so now let's talk about the two things that have been very hot. And let's talk about an area that, well, let's look at one last thing. Everybody loves the banks. Why do they love the banks? Because the banks charge a lot of fees. Well, on a 20-year basis, the banks still look like a pretty good deal as long as the XLF stays above 30 and 32. Okay. On a 5-year basis, not so much. Got to get above these numbers here. So really the road to 42 and 44 goes through 39 and 40. So keep an eye on that. This looks like it might be a spike low, but all it needs is that yield curve is flattening. If it ever goes inverted, that might be a problem here. So again, that's why this thing still looks like the bears are controlling it. Okay. Sometimes, going to the sideline and letting it sort out is a better idea than trying to, pick the low here and then find out it's not the low or hold on until it goes way down to 30, So you should have other tactics. At the end of the broadcast, I'm going to be going over hedging, which we've been trying to have people understand because obviously it's a big important thing. All right. So anyway, let's talk about something that, again, we showed you the S&P graph. I'm now going to show you the Treasury bond. Now, this is a proxy for the 20-year Treasury. It's called TLT. And we're going to go 20 years out. And I'm going to show you why we think there's a cyclical top that happened last year. Okay. So this is 2008, 2000. This is going back to 2006. Well, interest rates were dropping basically since 1980 area, 81. Right? Because remember we had, many don't, but I'll remind you of history. We had a very high inflation rate. When you hear it's the highest inflation in 40 years, they're referring to 1981. Okay. And when it was the highest rate of all time, I think we had a 10% inflation rate, not much more than we have now. And interest rates went up to 16% on the long bond. I think money market was 22%. And then the inflation obviously came back down. Now, PPI just came out this week, and I think it's annualizing out at 10%. That's wholesale prices at 10%. Now, we've been easing money and credit for 40 years, and in the last 20 years and 12 years, dramatically. And we've expanded the balance sheet of the Fed dramatically. And that's why you had asset values go like this. And that's why you had bonds go up like this. But right here, it looks to us as if that's a price that is not going to be seen. And it certainly won't be seen unless this TLT gets back above 150. And if it gets above 150 and we're ever going back to 180, that's probably not a good sign, because that means they have to ease money and credit tremendously to probably get us out of a very big deflationary situation. So at any rate, we actually hope we don't see those rates again, because again, they overdid it with money and credit creation. 35% jump in the money supply in a very short time, 9 trillion on the balance sheet in a very short time. That's called overdoing it. The S&P going from 2,000 to 4,800 in a matter of months is overdoing it. NASDAQ going to where it went, overdoing it. Valuations expanding like that, that's overdoing it, right? And after you overdo something, the down move can be somewhat painful. So again, we saw the stock market may have hit a cyclical peak at 4,800, and we saw the bond market, which in terms of TLT, hit a top, which means rates hit their bottom in March of 2020. Okay, so here's the third musketeer. And the third musketeer is commodities. And we think there could be a situation where commodities are peaking this year. Now, would it really surprise you if they did that? When you see the price of wheat, when you see the price of soybeans, when you see gold back at 2,100, when you see oil hit 135 a barrel, would it shock you that this could be the high year for commodities? So let's take a look. We're going to go back on the Goldman Sachs. Hang on here. Let's see if I can. Oh, I got to go back. Got to go back here so I can get the whole 20-year graph so you can see what I'm seeing. Okay. Because once you see the whole thing, it's very clear. Okay, GDH is the Goldman Sachs Commodity Index. Okay, and basically it's a basket heavily into oil with metals and grain. It's a big basket of commodities, and you can see a parabolic move to 850. It's already down to 679. So when we say there could be a top this year, you get the idea. But the idea was that we were going to go up and either test or exceed a little bit the 2008 top. And can you see the 2008 top on the Goldman Sachs? Now, again, this is all your oil. It's going to be very heavy on oil. It's going to be your metals, and it's going to be your grains. So we're going to get into those in a second here, but I'm trying to show you here that this could be a parabolic top. And it is a situation where look how far away you are from the moving averages. Would it shock you that we're somewhere near a high? We either made the high or we're going to be making a high. I mean, it's either that or it's a parabolic move, and you'll be talking about $8 at the gas station. I don't think that's going to happen, but anything could happen. So it's either going to be if we're seeing the high point, or there's something that you could hardly imagine that could keep going. Okay. Obviously, for the sake of society, let's hope that it is peaking, because I don't know that we can handle $9 a gas for gasoline. So anyway, you're looking at the number right here. Now it peaked right here. It looks like that peak was in March, right? Just this month. The high was 846. It went home today at 698. Okay. Could make another run at it. Could make another run. But again, it wouldn't shock us if somewhere between here and this 900 number, plus or minus a little bit, could be about it for this year. Okay. And now you can see why. Because again, it's how extended was it on this high? Very extended, right? How extended does it look here? Very extended, right? Okay. So it's possible. Now, if in fact that is at its high, let's take a look at some of the things that are in there. And we'll take a look at soybeans and take a look and see what that looks like. Agriculture. Okay. And agriculture, again, right up to the 2008 high, around 18 bucks. So if that 18 bucks is not going to get taken out, we are approaching or at what could be a high point. And look how extended you are from the moving averages. Okay. Let's take a look at wheat. And then I'm going to show you a couple of stocks that could be affected. And this is wheat. Again, parabolic, took out the high by a little bit. Again, we're looking for things to take out the high a little bit or to approach them. Now, this thing is, again, hit a high point of what? This month. Look at that. That doesn't look like it might have been a blow off top. The high was, where is it here? $14.25. Okay. And look how far away you are from the averages. Again, there's a reason for it, but things do change. We go from there is no oil to now we got a lot of oil. There is no grain, and now we have grain. There are no chips, and then there are chips. We have bottlenecks at the ports, and then we don't have bottlenecks. Valuations are 50 to 1 P ratio, then they're back to 25. Things change. The world is round. Okay, so that's your wheat. Okay, so you get the idea of grains. Now let's take a look at something like, well, this one here, palladium. I know that just went nuts. Yeah, okay, there's palladium. All-time high here, jumped up to, well, you heard nickel, up 250%. They had to close the London exchange. All right, so here you went up to 3,380 this month, and you're at 2,400. That sound like a blow off? Maybe. Now you have the gold. Now gold is up near its high. It doesn't seem like it has quite the extension, but it's certainly coming off the number that it hit earlier this month. It hit 2072. That's a little higher than what? 2063. And now it's trading 928. So got to watch it. Again, doesn't look as extended as the other commodities, so maybe it has another blow off leg ahead of it. That's possible. But again, palladium looks like a big blow off. Let's take a look at copper. Copper, pretty extended up here at around 5, took out the high up here as well. And then the last thing would be crude oil. Let's take a look at crude. Okay, so on crude, it looked like a blow off top, possibly 130. Well, it didn't get to 147. Maybe there's another leg left into it, but it certainly looks like it's peaked out at 130 or 130 and change. It's right now at 96. We'll have to see. Look how far it is from its moving averages. Would it shock you that that might have been the high? So again, we said the low in interest rates occurred in March of 2020, and you've got proof of that by looking at the graph. We said the high point in stocks may very well have been what we saw last in January, for a while anyway. And so basically you have some price evidence there. And now we're saying this year, the high point in commodities is being made as well. And again, this year you could see a low point in stocks. If we go down to that 3,600 neighborhood, I would love that from the standpoint of taking dry powder and put it to work, because the world will not come to an end. So obviously things that are down tremendously because of, fear of higher rates and all the rest of it, or just adjusting to higher rates and adjusting to geopolitical and adjusting to inflation, that may go away after things loosen up, but it's not going to all go away because those rents aren't coming way down. Those other things that are fixed costs like wages, they're not coming way down again unless we hit a huge recession, which is possible, but right now doesn't look probable because of household balance sheets and corporate balance sheets. At any rate, so here's some stocks out there that people are in that they might want to keep an eye on. What do you got in the oil patch? You got Chevron. Chevron looked like it might have had a blow off high. You tell me. All right. What do you got in the area of metals? Let's look at Newmont Mining. Now, this was something I was very keen on at 52 and 54 because it paid 4% dividend at that point, and it was very much low. Can you understand looking at this graph while I was keen on it at 52 and 54? Look at a graph right there. Pays 4% dividend. I don't want a piece of that? Of course I do. Now look at it. Looks like it had a blow off high a little bit, doesn't it? And look how far away it was from the averages. So there's your evidence. And so you got your Chevron, you got your gold, you got your oil, and then what about the grain? How's Mosaic look? Okay, well, again, it looks like it could keep going because, fertilizer and whatever, maybe there's more to come, but it certainly has gone a long way from $5 a share to 60 or wherever this high was. This high was at 65. Okay. Doesn't look quite as extended as the rest, so it's not exactly a grain only type deal. So again, this one is not as good of an example, but it's certainly extended. And let's take a look at Archer Daniels Midland, which is involved with the grains. And let's see how that's looking. That might be a little bit more extended. Yeah. Okay. So Archer Daniels Midland, does that look like it might, be somewhat near a high point here? I mean, the thing hit a high of what? Let's get it on the number here. Hit a high of one more over. It hit a high of 88. Okay, so 88 is trading at 82. Is it extended from the moving average? Looks like it. Did it have a parabolic move? Yes, it did. So you monitor this thing. If you're in there and you have a big gain, you can start thinking about how to hedge, which is what I'll talk about in a minute here. So again, the three main factors are energy, metals, and agriculture. And it looks from the charts that it's not far-fetched to think that we could be somewhat near a high point. Or if we're not, it's going to go make some hugely historic move beyond 2008. And that's going to be pretty darn dramatic on the economy because grain is our food and energy is the way we get around town. So obviously, I'm not hoping that there's a parabolic move beyond what we've already seen. And I don't think the powers that be want to see that either. And if they have any control over it, that could be interesting. Because don't forget, there is no grain. And what happens next? They grow some grain. There is no energy. And the next thing you know, they find energy. The world is round. Okay. That's why if we do get a great drop in the stock market, again, things go down for a reason. And then those reasons change. And that can be very good for it going back up. But it's kind of hard to hold on to things when they go from 4,800 to 3,600. And when your account goes down like that, it becomes very disconcerting. That's why I like to use the graph so that you can try to be into things that are going up and out of things that are not. And when you get a big gain on something, or you want to, shall we say, put parameters on your risk, then what you look into is hedging. Now, again, we told you we have a lot of experience in the market and a lot of knowledge about the markets. So what we did with all that is we created some PDF reports. And in these PDF reports, we try to outline the uses and the risks of certain things. And one of the PDF reports happens to have information on hedging or protecting your portfolio against market declines, and also how to use replacement trades so that you can replace stock positions with limited risk positions so that your cash risk is limited while you still have some exposure to the side of the market that you're looking for. Okay, so this is what we have put together, and I think everybody would be well served to have knowledge of this. Whether it is up your alley or not, that is for your brokerage firm to determine, and yourself, those of you who are aware of your circumstances, your risk tolerances, and your ability to do any business at all. So again, we don't do any advice and we don't do any recommending, but we do explain on the PDF report, how to use things such as collar strategies, how to use things like married puts, and how to use things such as replacement trades, which are used to substitute or replace an existing position and trying to do so in a manner that fixes your cash risk at a certain amount. Now, there is a benefit and a cost to everything you do. So you don't get, the same exact exposure as you would in holding a stock. You don't get the exact risk reward. And so it is not, apples for apples exactly, but it is a strategy or a tactic to try to keep you exposed to the market, but also bringing the cash risk you have in the market down. And that can be very effective in either a market that has gone way up and you're trying to take that big gain, but also maintain some type of a long position, but a long position with limited risk. Or it could be a situation where a stock has gone from 350 down to $80 and every relative you have is banging you on the head to get out. And you think it might be at a low point, but how much more heat can you take in the kitchen? And so you might take the position off and replace it with a limited risk strategy where it gives you potential to make money on a big up move, but it caps your risk cash wise to a much lower level than it would be by holding the underlying stock. So these are some of the things that we cover. And some of the things we discuss also is well, again, the main thing on hedging is protecting and reducing cash risk. So putting parameters around your equity rather than having absolutely no parameters around your equity. And clearly, in hindsight, from 4,800 down to where we hit as low as 4,100, it would have been nice to have some kind of hedging going on. So many people say they know about it, but I doubt if they were asked to give details, they could recite it. So knowledge is power. And we do think very strongly that you should pick up this PDF report and get educated. And then at least you have the knowledge behind you. And then you can go to your brokerage firm and find out, and your advisor and your broker to find out what, if anything, is appropriate for your circumstances. Okay. Because again, we don't give advice on any particular situation. To get this is real simple. You go and you either contact us. You can contact us by telephone. You can contact us by email. The email is option, OPTION, professor, PROFESSOR @gmail.com. And put your contact information in there and we'll contact you and explain how you can get this information. Number two, you could visit the website and put your information in there as well. That's option, OPTION, professor, PROFESSOR.com, and put your information in that way as well. And when you do that, again, you will get the details and you'll be able to speak to me directly. And again, if you have questions on things, we can talk about some of the things, and I can share with you some of the indicators I use to come up with how these markets go up and down. And after all the decades of experience, I think there's some things that we've come to the conclusion of that, that are helpful. Just to give you an idea, the reason you have to come to some conclusion is this is some of the areas that they have for technical analysis. Okay. So just look at all these choices here and look at all that data that you'd be trying to figure out and talk about analysis through paralysis or whatever they call that. That's a lot of information. So at some point you have to whittle down things that you feel are important or are more important than others. And we've done that. And so when you do give us your contact information, we can also share that with you as well. So again, optionprofessor@gmail.com and or call the number at the website or go to the website, put your information in, optionprofessor.com. Okay. Again, there's a lot to talk about. I went over quite a bit. I didn't even hit the international scene. The reason is stay away from international right now, because again, Europe's in a recession possibly, and China obviously is in lockdown, so you want to see some smoke clearing before you consider international right now. I am going to be signing off here. I'm the Option Professor, and I do look forward to hearing from you and speaking to you, and most importantly, to provide to you and share with you the report on hedging both downside risk and upside surprises. I really think it would help, and so that's why I'm suggesting you take advantage of it while you can. Okay. Well, thanks a lot for being here, guys. Again, I am doing this in advance of the Fed meeting and in advance of the triple witching and the full moon from March 18th. So there could be a lot of activity next week when I return. And when I do return, all of you that are contacting us, I'll make sure we get a hold of right away. Again, thanks a lot for being here, guys, always. And good luck and good trading. And let's see how the cards come out after these reports on Wednesday and triple witching. And we'll all be here next week to talk about it. Okay. Have a great day. Optionprofessor.com signing out.